I've been on the internet for a long time. And in that time, I have seen some things. And I often get DMs from my audience members asking me about particular advice they happen to see on TikTok or Instagram. Now, of course, not all financial tips on the internet are incorrect. However, especially when it comes to short form type videos where you're seeing a 60-second video on Instagram or TikTok, it's likely that the context is not fully there. And when it comes to business finances, context is everything. And that's why you'll find that I don't do a ton of short form content. And that's because I feel like it can be really misleading without adding a little bit of context. Now, I'm a person who is especially passionate about accessible financial information, but I also know that any advice you're getting from the internet or even from a direct service provider like an accountant or a tax professional, you still need to be able to sense check. And the reason that I make the content that I make about business finances is not to tell you exactly what you should or shouldn't do, but to help give you that ability to sense check information yourself and know what questions to ask. So today we're going to do things a little differently, and I'm actually going to react to some of the advice that I have seen online that you all have sent to me and asked for my opinion about. And I'm going to help you figure out how to determine if advice is correct, incorrect, or needs a little bit more context. Now, for those that don't know me, hi, I'm Jamie Trull, CPA and financial educator. And my goal in this channel is to help small business owners and self-employed individuals get organized, increase profit, and pay less taxes. So if that sounds good to you, make sure you like and subscribe. Now let's jump into clip number 1.
Stop owning things in your personal name. Employees, everything's in their personal name. As an individual, you don't get the same tax write-offs as an LLC. So for example, this is a business. I go start a YouTube channel as an LLC, right? And I make $10 a year. The thing could lose money. It doesn't matter. Now, because I'm on YouTube, guess what I get a write-off, Andre? I get a write-off my travel, my food. I get a write-off my camera equipment, my audio equipment, my clothing. Every single thing you see me wear was a tax write-off because it's on camera. It's my uniform for my brand. My food for my family is a write-off. Andre, how is that possible? My wife and I are partners in our LLCs, and when we're sitting down at the dinner table, we're having conversations over a meal. Everything's a business meeting. When I take my kids to Disneyland, it's education expense for my future trust beneficiaries. I'm educating these kids. I'm taking them out, showing them other cultures. I'm teaching them other languages. I'm giving them experiences, and I'm building them into the future board members of my trust.
Okay, there was a lot in there. And the first thing that I will say is I do acknowledge that if you are running a business, an actual business, then you actually have a lot more opportunity for things that you can write off on your taxes. However, there are limits here. Now, the first thing that he mentioned is that if you had a YouTube channel making $10 a year, you can write off all of this stuff. But the problem with that is that if you're making $10 a year and writing off thousands of dollars of expenses to that business for multiple years in a row, the IRS is going to come in and tell you, actually, that's not a business, that is a hobby. And in order to not be a hobby, you have to have a profit motive. And there are a few things that the IRS will look at to determine if you have an actual profit motive. That can be things like the business plans and forecasts that you do. But the main indicator the IRS will use to determine if you truly have a profit motive is, have you made a profit 3 out of the last 5 years? And if the answer is no, it's very likely under audit that all of those expenses would be disallowed. And that's a bad thing because you still have to claim the income for tax purposes, but if it's a hobby, you would not be able to claim any deductions against it. Now, the other thing that I want to mention here is that he seems to imply that setting up an LLC is somehow better than operating as a sole proprietor when it comes to deductions. And that's actually not true. The accounting is exactly the same whether you're functioning as a sole proprietor or an LLC. The thing that changes is the legal liability. So when you set up an LLC, you would not be personally liable if someone were to come and sue you in most cases. But from a tax and accounting perspective, it's exactly the same. You're going to be filing a Schedule C with your tax return either way. Now, what I find the most egregious here is not just the fact that this man literally put this on the internet for everyone and the IRS to see, but also the brazenness with which he states the things that he is deducting that absolutely are not actually deductible. Now, when it comes to things like recording equipment, if you have a YouTube channel with the intention of having a profit motive, that's key, then yes, you absolutely can write off all of your things. You can write off the camera that I'm using. I definitely wrote that off. The microphone that I have in front of me. All of that is a write-off. Now remember, a write-off doesn't make something free. It just makes it such that your taxable income can be lowered by the amount of your deduction. But where he gets a little cute, in my opinion, is when he starts talking about the vacations that he goes on and even the meals with his own family being deductible. Now, sure, if you're a travel YouTube blogger and you really are going on trips where the main purpose is for business, that's key, right? Then a lot or maybe even all of that trip can be deductible. There are lots of rules to know around that, and I actually have a video that talks about when you can get trips deducted. There are some really good rules to know, and I do tend to try to get as much of my trips that I take deducted as possible. However, the whole idea of taking your kids to Disneyland and saying that that's education for your future trustees, I would love to hear this guy explain that to an actual IRS agent. I'm going to tell you the result would be that person laughing in their face and then getting a big tax bill slapped on them. Now, I do know of situations where if you really do run a company with a profit motive, there may be opportunities that you can take your family on a vacation, but also have part of it be for business purposes. But you're gonna have to document that really, really well, especially if the people on that trip are your family. And again, that's some nuance that is left out of this 45-second video. Now, I also want to address the clothing. He says he writes off his clothing because he wears it in videos. Let me tell you right now, this outfit, as much as I would love to have written this off to my business, I know that that is not an ordinary or necessary expense and therefore is not a write-off. However, if I were to put, say, my business logo on it, that's a different story. In that case, you may be able to make the case that it is truly a uniform or perhaps a marketing and advertising expense. But regular clothes that you can wear in your daily life as well absolutely do not count as a write-off, I'm sorry to say. Okay, now that we've thoroughly debunked that one, let's get on to the next clip, which is one of my favorite topics.
Here's a list of all the expenses that are tax deductible. The interest on your car note is tax deductible.
Boom.
Your car insurance, car washes. Yes. Car washes details. Keep your car clean.
Got you.
Repairs, maintenance, tires, oil changes, parking, tolls. All these expenses related to your car that you're currently paying from your personal account are now business expenses if you can prove that you're using the car for business.
Got you.
Okay, now herein is one of the reasons that I hate these short clips for social media, because everything he's saying is somewhat true, or true if you add context. But the way that he's saying this makes it sound like just because you're using your car for business at all means that you get to write off everything under the sun as a business expense. And that is not true. You do have to show the percentage you're using your car for business, and only that percentage of those actual costs can be written off to your business. And it's also important to say that you can't write off all of those actual expenses and your mileage. That is double dipping. Now, if you're writing off mileage, which is the amount of miles you're actually driving for business, you get 72.5 cents for every mile you drove. Again, just for business purposes. But you can't take that and your actual expenses like insurance, maintenance, all of that stuff. It's one or the other, because that business mileage is meant to encompass all of the costs related to your car. Now, as far as which is the better deduction for you, you'd want to work with an accountant on that, and you unfortunately can't just switch back and forth and take mileage one year, actual expenses the next year, and mileage again the next year related to the same car. But in my experience, unless you're driving around a luxury vehicle, the per mile rate is often going to give you a better deduction than taking actual expenses. And the IRS does adjust those mileage rates pretty frequently. Sometimes they actually change during the year, especially when you see big spikes in gas prices and things like that. But like I said, the biggest piece of context that is missing from this short little video clip that is so important is that you could only deduct the portion related to the miles you were driving for business And that has to be fully documented. Where you went, why it was for business purposes, those are all things that the IRS is going to want to see if you are audited. Okay, now on to the third and final clip, and this one is about cost segregation studies. And I do want to be clear before you watch this that things like cost segregation studies and these various different real estate tax strategies are a real thing. However, as with the other clips, there is so much key information missing that it makes this misleading.
Here's how you can avoid 100% of your income taxes every single year. We call this strategy the paper loss strategy. In order to use it every single year, you have to understand the rules. The very first thing that I'm going to need you to understand is you're going to need to buy an investment property. When you buy a rental property, it could be an Airbnb or it can be a long-term rental. But as soon as you purchase the property, I want you to write off everything that's on the inside of the property. This could be appliances, bathrooms, tubs, cabinets. And when you write off everything that's inside of the property, it creates a big expense. We call this the cost segregation study. Once you do the cost segregation study, it creates a big enough loss to offset your W-2, your 1099, your stock, and your crypto income, making you tax-free. Comment below if you'll be investing in real estate to avoid W-2 and 1099 income taxes.
Okay. A couple of things that are really important here. The first that I'm going to point out is he mentions that doing this can help you offset your active income like W-2, 1099 income. And the thing that's missing from this that is really, really important to understand is that there is a different treatment tax-wise if your activity is considered to be passive versus active. In order to be able to deduct any losses on a cost segregation study against your active income, you would need to be able to pass the material participation test. And that test has a lot of different things that the IRS would look at to determine if you truly are materially participating in that rental. And the IRS has multiple different things that they look at to determine if you are really materially participating in that rental activity. So for example, things like the 500-hour rule, you need to be spending at least 500 hours managing this property in the year in order for it to be considered active and not passive. And the problem is, if it's considered passive activity, you cannot offset those losses against your active income. So ultimately, you get a whole bunch of tax losses that you can't even take. So that's the first way that this breaks down. If you are a real estate investor and that's what you do by your job, then it's easier for you to be able to pass these active rules. However, if you're a person who just bought a property because you heard it was really great for taxes and wanted to offset your tax bill, then there are a lot of things you need to know because you can do them wrong. And if you do them wrong, it completely eliminates any tax benefit you could have. And the next thing that drives me a little bit crazy about this particular video is the idea that, okay, if you're trying to reduce your taxes, just go buy a rental property. It's that easy. Well, that's gonna take capital, that's gonna take some know-how, right? It's not that easy to just go buy a rental property, do a cost segregation study, and write off everything. And even if you do that this year, let's say you go buy a rental property, you do everything correctly, you qualify under those active rules, you do your cost segregation study, you write everything off up front against your active income this year. Well, then flash forward to next year, what are you gonna do? Now, all of a sudden, in order to get the same tax benefits, you're gonna have to go buy another rental property forever into time. And let's not forget, you're probably taking out debt to do so, so you're paying interest on that debt instead of paying taxes. Now, while that could be a good move, depending on your situation, it often isn't, and it's a lot more work than these 30-second clips make it out to be. Yes, there's a lot of room for upside in real estate owning, but there's also a lot of risk. So this is not just a casual strategy that you should decide to do without really spending time looking at it. So all in all, what's my takeaway from these 3 clips? Well, sound bites leave out context. Be careful taking advice from TikTok or Instagram in 60-second sound bites. Heck, be careful taking advice from 10 or 15-minute YouTube videos as well. This type of content is great for a starting point, for a jumping off point to then have discussions with trusted professionals who can help you. Even when you're watching content like mine, I want you to double check for yourself. I don't know your specific situation, so I can't tell you exactly what to do. All I can do is help you figure out how to ask the right questions while you're on your financial journey. Unfortunately, nobody else is going to be responsible if you take a bad tax tip off of Instagram. The IRS doesn't care what influencer told you you could do it. They don't even care if your accountant told you you could do it. At the end of the day, you're going to be on the hook. This isn't one of those areas where you can just play dumb. If the IRS comes a-knocking, you need to make sure you know enough to stay safe and make good decisions in your business. Now, if you're not sure where to start on your financial journey, I want you to go take my brand new Profit Path Diagnostic, which is going to tell you exactly where you are on the journey, give you some information about your business and the things that are most important for you to be doing at this stage right now. You can go check that out at jamietrull.com/profit path. Now, if you like this video, I'm going to do some more Reacts videos, so go ahead and link anything you want me to react to down in the comments. And of course, please make sure to subscribe so you see future Reacts videos. Thanks for joining me, and I'll see you next time.